Disclaimer: this video is for general educational purposes only and should not be considered financial advice. Always do your own research and consider seeking professional advice before making investment decisions. You've learned what shares are, how they can build wealth and the risks involved. But how do you actually buy one? Today, buying and selling shares is easier than ever. With just a few taps on your phone, you can own part of some of the world's biggest companies. But understanding how a trade actually works can help you avoid unnecessary costs and potentially get a better price. Let's walk through the process. When I first became interested in investing, placing a trade wasn't nearly as simple. If you wanted to buy shares or options, you often had to call a stockbroker, tell them what you wanted to buy, how many shares you wanted, and they would place the order for you. It looked a bit like those old Wall Street movies with traders shouting across the trading floor. Today, most investors simply open a brokerage app, search for the company they want to invest in, and place the trade themselves in a matter of seconds. The first step is deciding which company you want to invest in. For example, you might search for Apple, Microsoft, or Coca-Cola. Once you've selected the company, you'll normally see the current share price, today's price movement, a price chart, buy and sell buttons. You'll then choose how much you want to invest. Some brokers ask how many shares you'd like to buy. Others allow you to invest a dollar amount instead, automatically purchasing fractional shares if needed. At this point, many beginners simply press buy. But before you do that, it's worth understanding what the prices on your screen actually mean. One of the biggest surprises for new investors is that the price shown on your screen isn't always the price you'll actually pay. The number displayed is usually the last traded price. That's simply the price of the most recent completed trade. The price you actually pay depends on the current buyers and sellers in the market. That's where the bid and the ask come in. What is the bid? The bid is the highest price someone is currently willing to pay for the shares. Think of it as the best offer currently available from a buyer. What is the ask? The ask is the lowest price someone is currently willing to sell those shares for. It's the cheapest selling price currently available. Understanding the spread. The difference between the bid and the ask is called the spread. For example, the highest buyer is offering $99.95. The lowest seller wants $100.05. The spread is 10 cents. That doesn't sound like much, but imagine a share worth only $1. A 10-cent spread now represents 10% of the share price. That's a significant cost before you've even made a profit. Generally speaking, large companies with lots of buyers and sellers usually have smaller spreads. Smaller or less frequently traded companies often have much wider spreads. If you've watched my video on liquidity, you'll know that more liquid investments are generally easier and cheaper to trade. When you press buy, your broker will normally ask what type of order you'd like to place. The simplest is a market buy order. A market buy order tells your broker, buy these shares immediately at the best available price. The advantage is speed. The disadvantage is that you don't control the exact price you'll pay. If prices move quickly, you could end up paying slightly more than expected. The same applies when selling. A limit buy order gives you much more control. Instead of saying buy at any price, you're saying only buy if the price reaches this amount or lower. For example, if a share is trading around $100, but you're only prepared to pay $99.50, you can place a limit buy order. If the ask reaches your price, the order may be filled. If it doesn't, the order simply won't execute. A limit order doesn't guarantee you'll buy the shares. It simply guarantees the highest price you're prepared to pay. Many experienced investors prefer limit orders because they know exactly what they're prepared to pay. Here's a simple example. With a market buy order, you buy immediately at the current ask price, which in this example is around $100.05. With a limit buy order, you decide the highest price you're willing to pay. Here we've set a limit of $99.50. If the ask price falls to that level, the trade goes through. If the ask stays above $99.50, no trade occurs. What is slippage? Slippage occurs when the market price changes between the moment you place your order and when it is actually executed. Imagine you're buying a house advertised for $800,000. You arrive ready to make an offer, but while you're completing the paperwork, another buyer offers $810,000. If you still want the house, you'll need to pay more. That's essentially what slippage is. In the share market, this can happen in fractions of a second. The faster prices are moving, the more likely slippage becomes. Fractional shares. Many investing platforms now allow you to buy fractional shares. Instead of buying one whole share, you might buy half a share or even 1/10 of a share. This can make investing much more affordable, especially when expensive companies have share prices worth hundreds or even thousands of dollars. However, it's worth understanding that many platforms handle fractional shares differently from whole shares. When you buy a whole share, your order is generally matched in the market with another buyer or seller. But when you buy a fraction of a share, many platforms temporarily become the other side of the transaction before later buying or selling shares in the market to balance their own position. Because of this, the bid and ask prices shown for fractional shares may not always perfectly reflect the prices available on the wider market. If you're making a larger investment or simply want a quick sanity check, it can be worthwhile comparing the share price on another reputable market data service before placing your order. Buying whole shares, where practical, can also make pricing more transparent. Brokerage fees. Even if you buy at a great price, don't forget about fees. Depending on your broker, you might pay brokerage commissions, foreign exchange fees, platform fees, withdrawal fees, currency conversion costs. Many brokers now advertise commission-free trading. That's great, but it's still worth understanding exactly how your broker makes money and what fees may apply. Remember, fees are one of the few investment costs you can actually control. How to get the best price? Here are a few simple ways to reduce trading costs. Use limit orders whenever appropriate. Trade during normal market hours when there are plenty of buyers and sellers. Avoid chasing rapidly rising prices. Compare prices with another reputable market data service if something doesn't look right. Be aware that fractional share pricing may differ slightly from whole share pricing. Remember that more liquid investments generally have smaller spreads. None of these guarantees the perfect price, but together they can help reduce unnecessary trading costs over time. Before you click buy before placing any trade, take just a few seconds to check these 5 things. First, have I entered the correct number of shares or the correct dollar amount? Second, am I happy with the price I'm about to pay? Third, do I understand the fees involved? Fourth, am I using the right order type, such as a market buy order or a limit buy order? Finally, does this investment fit my long-term investment plan? Those few seconds of checking can help prevent expensive mistakes and encourage disciplined investing rather than emotional investing. Buying and selling shares has never been easier, but becoming a successful investor isn't just about pressing the buy button. Understanding how trades work, knowing the difference between market buy orders and limit buy orders, recognizing the impact of spreads, slippage, and fees, and taking a few moments to review your order can all help you become a more confident investor. Every small improvement you make when buying and selling shares can add up over many years of investing. If you found this video useful, please click the subscribe button. It costs you nothing, but it really helps the channel and lets me know you'd like to see more practical investing videos. Thanks for watching, and I'll see you in the next video.